Everyone assumes Amazon killed Circuit City. They're wrong. When Circuit City filed for bankruptcy in November 2008, Amazon wasn't even close to dominating electronics retail. Best Buy was thriving. The economy was brutal, yes, but Best Buy survived the same economy just fine. So what destroyed Circuit City specifically? The answer is one number: $10.23. That was the maximum hourly wage Circuit City decided its best employees were worth. Everything that followed from that decision was inevitable. Samuel Wurtzel opened a small appliance store in Richmond, Virginia in 1949. He named it Ward's Company. He was selling televisions at a time when most American families had never owned one. Over the next 5 decades, that small store grew into something remarkable. Circuit City pioneered the big-box consumer electronics retail concept. Massive showrooms packed with televisions, stereos, computers, and car audio equipment, staffed by salespeople who actually knew what they were selling. By fiscal year 2000, the company reported revenues of $12.4 billion. It operated over 600 stores and employed more than 60,000 people. Circuit City was the second-largest consumer electronics retailer in the United States, and its only serious rival was a company called Best Buy. But Circuit City wasn't just a television retailer. In 1993, the company launched something that had nothing to do with electronics. They called it CarMax, a chain of used car dealerships that applied the same no-haggle big-box logic to automobile sales. It worked. CarMax became enormously profitable. Customers loved the transparency. But in 2002, facing financial pressure and a deteriorating balance sheet, Circuit City's executives made a decision that would become the first quiet signal of what was to come. They sold CarMax. They raised approximately $827 million and walked away from a business that analysts believe would eventually be worth tens of billions. They needed the cash. And cash, for Circuit City, was becoming harder and harder to hold on to. While Circuit City was selling assets to raise cash, Best Buy was doing the opposite. Through the late 1990s and into the 2000s, Best Buy expanded aggressively. More stores, better layouts, lower prices, trained staff. Best Buy invested in the customer experience while Circuit City cut costs to protect margins. The gap between the two companies widened every quarter. By 2005, Best Buy had surpassed Circuit City as America's dominant electronics retailer. Circuit City was still enormous, but it was losing ground, store by store, quarter by quarter. The board knew something had to change. In 2006, they brought in a new chief executive. His name was Philip Schoonover, and he had a plan. Philip Schoonover came to Circuit City from Best Buy. He understood electronics retail. He understood competition. And when he looked at Circuit City's cost structure, he saw a problem, and what he believed was a solution. Labor was expensive. Specifically, the hourly store employees who had been with the company for years were earning wages above what Schoonover believed the market required. His plan was surgical in its simplicity. Identify every hourly employee earning above the new pay ceiling for their role and terminate them. In fiscal year 2007, the same year he executed this plan, Philip Schoonover was paid $8.5 million in compensation. The employees he targeted were earning, in some markets, as little as $10.23 an hour. On March 28, 2007, Circuit City issued a press release. The company announced the termination of 3,400 hourly store employees, effective immediately. The language was clinical. These employees, the release explained, were being separated from the company not because of performance issues, but because they were earning above the established pay range for their positions. They were too expensive. To make the insult complete, those employees were told they could reapply for their own jobs after a mandatory 10-week waiting period. The catch: they would have to accept the new, lower starting wage. Many of these people had worked at Circuit City for 5, 10, 15 years. They had built careers. They had been the institutional memory of the stores they worked in. Wall Street's reaction was immediate. On the day Circuit City announced the layoffs, Best Buy's stock went up. Investors didn't need a consultant to explain what had just happened. Circuit City had handed its most dangerous competitor a gift. Best Buy's chief executive, Brad Anderson, began actively recruiting Circuit City's fired employees almost immediately. He would later, publicly, call the layoffs a gift to Best Buy. The most experienced floor staff in the American electronics retail market, people who could close a $1,500 home theater sale in 8 minutes, reportedly walked out of Circuit City stores and into Best Buy's hiring pipeline. Best Buy gained institutional knowledge it had taken Circuit City decades to build, and it paid nothing for it. The damage in Circuit City stores was less visible than a stock price movement, but far more consequential. Electronics retail in 2007 was not a self-service business. A customer deciding between two 42-inch plasma televisions, priced at $1,200 and $1,500, was not going to choose based on the box. They needed guidance. They needed someone who understood the difference between 120 Hz and 60 Hz, who could explain HDMI inputs, who had sold this exact television 100 times and knew which questions to ask. Circuit City's new minimum wage replacements, rushed through minimal training, could not provide that guidance. Customers asked questions and got shrugs. They walked out. They drove to Best Buy. And they didn't come back. The financial results arrived with the quiet certainty of a verdict already rendered. Circuit City's same-store sales began declining in the quarters following the layoffs. Each report was worse than the last. Meanwhile, Best Buy reported same-store sales growth of 8.3% in the fourth quarter of 2008, the very quarter that Circuit City was disintegrating. Customers weren't abandoning electronics. They were abandoning Circuit City. The $110 million in projected annual savings from the layoffs was being outpaced, many times over, by the revenue that was walking out the door with every confused customer who couldn't get an answer to a simple question. 10 months after the employee layoffs, Circuit City took the next step in its own undoing. In January 2008, the company announced the closure of 155 stores and the elimination of 17,000 additional jobs. Each closure created a self-reinforcing spiral. Fewer locations meant less convenience, which meant fewer customers, which meant worse sales, which justified further closures. The stores that remained open were understaffed, undersupplied, and increasingly difficult to shop in. Suppliers began tightening credit terms. Landlords began calculating their exposure. Competitors began identifying which Circuit City customers they could absorb. The company that had tried to save itself was accelerating its own collapse, one announced closure at a time. By the time 2008 was half over, Circuit City owed $898 million to creditors. Samsung was owed $119 million. Sony was owed $116 million. These were the brands whose products needed to be on Circuit City's shelves for the stores to function. Without inventory, there was no revenue. Without revenue, there was no way to pay the debt. The global financial crisis that erupted in the fall of 2008 sealed it. Banks stopped lending. A private equity firm called Great Hill Partners assembled a rescue bid worth $700 million and watched it collapse when banks refused to provide financing. Circuit City had run out of money, out of credit, and out of options. The end was now a question of timing, not outcome. On November 10, 2008, exactly 20 months after the March employee layoffs, Circuit City filed for Chapter 11 bankruptcy protection. The company that had tried to save $110 million a year had burned through its foundation. Executives issued statements about restructuring, about finding strategic buyers, about emerging leaner and stronger. The holiday shopping season was approaching. A Christmas miracle might provide the revenue needed to stabilize the balance sheet. Circuit City marked down its inventory. It ran promotions. The customers came in to buy the discounted goods, and then they left. The miracle did not arrive. What came instead was January. On January 16, 2009, Circuit City announced total liquidation. There would be no restructuring. There would be no buyer. All 567 remaining stores would close. All 34,000 remaining jobs would be eliminated. A company that had been operating for 60 years, that had pioneered big-box electronics retail in America, that had launched CarMax, that had once been a $12 billion institution, was being erased. Liquidation banners went up in every store. The shelves emptied in weeks. Customers came to pick over the carcass of a company they had stopped supporting years earlier. On March 8, 2009, the last Circuit City stores went dark. The arithmetic of Circuit City's destruction is almost too clean to believe. The 2007 layoffs were projected to save $110 million per year. Circuit City had once been valued at over $1 billion. The total enterprise value of the company, its stores, its brand, its infrastructure, represented decades of accumulated investment. The experienced salespeople who were fired to save a few dollars an hour had been the very people generating the high-ticket sales that justified the company's entire business model. You cannot sell a $1,500 television with a minimum wage employee who was hired 3 weeks ago. The savings were microscopic. The damage was absolute. Business schools teach Circuit City's collapse under a concept called false economy, the act of saving money in a way that destroys far more value than it preserves. Schoonover's team confused cost with value. The employees who earned more also sold more. In a knowledge-intensive sales environment, expertise is not a line item to be minimized. It is the product. Best Buy's leadership understood this intuitively. Circuit City's board signed off on a decision that gutted the only competitive advantage their stores had left. Philip Schoonover was eventually forced out in September 2008, 2 months before the bankruptcy filing. By then, the outcome had long been inevitable. Circuit City was not killed by Amazon. It wasn't disrupted by streaming or destroyed by a pandemic. It was not outcompete on price or beaten on selection. It was killed in a single boardroom decision by its own executives in 20 months. The store that helped America fall in love with color televisions, personal computers, and home theater systems chose to fire the people who made that love story possible. That is the story of Circuit City, not a cautionary tale about technology or disruption, but a case study in the oldest corporate failure there is, choosing the number on a spreadsheet over the human beings who made that spreadsheet possible. If that story resonated, subscribe to Rise and Ruin. History's greatest business collapses are always an inside job.